It's been a volatile stretch for the stock market, from the pandemic-induced sell-off in early 2020 to recent record highs in 2021. The market has certainly tested investors' mettle. But when looking for the best stocks, investors should consider long-term performance, not short-term volatility. The key to being a successful investor is being patient. You should let your profits ride and not cut them short unless in need of liquidity. So in this video, we're going to tell you about the top 10 stocks of 2022. The video is going to be amazing, so make sure you stick to the end. Before starting the video, be sure to smash that like button just like you should do if you haven't done so already. Never miss out on any of our videos. Number 10. Netflix, NFLX. Netflix, Nasdaq, NFLX stock has delivered extraordinary returns for shareholders over the past 3, 5, and 10 years. Those gains have been fueled by growth in its subscribers, revenue, and profits. As with other home entertainment stocks, COVID-19 proved to be a positive for the company, resulting in increased subscribers, revenue, and earnings. Rising profits are a result of a powerful flywheel at Netflix that is showing no signs of slowing. Increasing membership totals generate more revenue, which in turn increases the amount of Netflix can spend on content. Fresh and exciting content attracts and retains members, which then generates even more revenue. Number 9. Fiverr, FVRR. Fiverr International, NYSE FVRR, is an Israel-based technology company that has nailed the gig economy's demand for creative services work. Usually, when an economy recovers from hard times, companies don't hire full-time workers right from the start, especially if they're looking for creative and computing talent. That's where Fiverr comes in. When people couldn't go to offices during the lockdown, companies had to reframe how to remain productive outside of the traditional workplace environment. FVRR stock is up 755% in the past 12 months and still sporting a market cap of $7 billion. That means there are plenty of growth left in existing markets as well as markets it has yet to move into. Number 8. The Walt Disney Company, DIS. The Walt Disney Co., DIS, is a global entertainment company that operates a broad range of businesses, including theme parks, resorts, a cruise line, broadcast TV networks, and related products. When it comes to the Walt Disney Company, analysts seem to love the stock. 19 analysts currently cover it, with 16 ratings it a buy and 3 ratings it a hold, with an average price target of $217 per share, representing the potential for more than 17% growth over the next year. All in all, Disney has struggled from time to time, but you can never count the stock out. The company has a history of pivoting and making changes that are best for its growth and its investors. That's not likely to change. Number 7. Walgreens Boots Alliance, WBA. Walgreens Boots Alliance, Nasdaq WBA, is a global pharmacy-led health enterprise with a large presence in the United States and Europe. Thanks to its steady dividend and earnings per share (EPS) prospects, Walgreens' stock remains one of the best stocks for 2021. WBA stock currently has a relatively high dividend yield of 4.1%. That said, future dividend growth is also very likely at Walgreens. Therefore, with a return to better EPS figures, you can expect EPS growth of 5% per year going forward for Walgreens. So although WBA stock has fallen from grace a bit in the past month, there are still plenty of positives on the horizon for Walgreens, and that makes WBA stock one to watch. Number 6. Apple, AAPL. Apple has established itself as one of the world's premier brands. As you likely know, Apple is the creator of the iPhone, iPad, and Mac computers, with the iPhone representing the vast majority of the company's revenue. It's one of the largest smartphone manufacturers with a 15% market share as of the second quarter, up from 12% in the prior quarter. And it enjoys a leadership position in tablets and smartwatches, but Apple is more than shiny hardware. Notwithstanding recent volatility, the stock is currently trading with a relatively high valuation when compared to the industry average. However, like other big tech names on this list, the high valuation associated with the stock is offset by the strong growth seen in revenue and earnings, growth that many believe will continue for the foreseeable future. Number 5. Oncocyte, OCX. Deemed as the future of healthcare, the molecular diagnostics company uses genetic testing to help doctors and patients alike make better healthcare decisions. Oncocyte reported Q1 earnings back in May, and the results were as good as you would expect from this soaring stock. Revenue of $1.12 million beat analyst estimates, and losses per share of 5 cents, and also beat Wall Street's quarterly outlook of a 10-cent loss. Moreover, according to Ron Andrews, CEO and president of Oncocyte, the company's recent acquisition of Chronix Biomedical, will play an important role in our long-term growth, providing an entry into the emerging $5 billion global therapy monitoring markets with a patented novel, blood-only tumor-naive approach that will deliver faster information on disease progression compared to the competing tumor-informed approaches that require tissue samples. Overall, the performance of OCX stock in 2021 has been quite incredible, and based on its recent earnings and business ventures, it's not showing any signs of slowing down. Number 4. Amazon AMZN. Amazon.com AMZN, which began life as a modest website for book buyers, went public in 1997 and has since created nearly $1.6 trillion in value for shareholders. For months, consumers were told to stay at home, only leaving the confines of their homes in search of absolute necessities. While there were already growing numbers of consumers shopping online, travel restrictions and temporary lockdowns led to a tidal wave of consumers who shifted from brick-and-mortar shopping to shopping on the web. Since June 2020, the company's stock price has climbed from around $2,545 per share to nearly $3,500 per share. Amazon continues to make huge strides in the analog retail world too. For example, it owns the Whole Foods grocery store chain and built its own freight and logistics operations. With its relentless focus on investment and expansion, analysts expect Amazon to continue to deliver outsized growth for the foreseeable future. Number 3. NIO. As with many other sectors, it has been a wild ride for electric vehicle EV stocks in 2021. Despite a rough start to the year for NIO, sentiment is actually looking up for a solid Q2. Strong delivery figures during the period, coupled with a solid Q1 earnings report, have NIO stock heading higher from its 2021 lows. Additionally, the EV company also has plans to expand its footprint into other countries. That said, there clearly has been a lot going on for NIO thus far in the year. But where can it go from here? As investor plays writer Vivian Medithi puts it, the Biden infrastructure plans looks set to benefit EV makers across the board, but particularly Tesla competitors, and rumors have been swirling regarding NIO's entry into American markets. However, until those rumors are substantiated, investors are better off keeping an eye on the short float in NIO stock. So while it may not look great in terms of YTD gains, NIO stock still has plenty of time to be one of the best stocks of the year. Number 2. NVIDIA only recently muzzled its way into the best stocks of the past 3 decades. Today, the company's high-tech computer chips are used in various servers and data centers. Given the company's dominance in the data center space, chances are its chips are being used in the server. As technological innovation continues, GPUs are becoming increasingly important. Over the years, the company has proven that through continued innovation, its chips are likely to stay on top of the competition. Few blue chips offer so much exposure to so many emerging endeavors and technologies, which explains the semiconductor stock's relatively recent meteoric rise and the outsized wealth it's created for shareholders. Number 1. IZEA Worldwide IZEA Worldwide Incorporated. IZEA is near the top in its sector according to Investors Observer. IZEA gets an overall rating of 54. That means it scores higher than 54% of stocks. So what was causing the massive surge in IZEA stock? Accelerating business volume sparked by a rapid shift among enterprises toward digitally naive influencer marketing in a world where consumers are becoming increasingly distrustful of ads. And despite falling off a bit, this movement can absolutely continue for IZEA. IZEA launched Shake in late 2020 as a marketplace for influencers. In short, influencers list their talents on Shake, and brands browse through the marketplace to contract influencers for their campaigns. So when that finally hits its stride, expect to see IZEA stock benefit in a major way. Let us know your opinion in the comment section below. This was all for today. Hope you liked the video. Don't forget to like and subscribe to our YouTube channel. Stay safe, and we'll be back soon with another video just for you guys.